The markets closed yesterday at normal levels. Silver traded quietly around $71. The headlines focused on inflation data and currency movements. But while analysts debated quarterly earnings and central bank policies, something fundamental shifted in the physical world. Something that makes yesterday's closing price irrelevant. In Shanghai, physical silver is trading at $86 per ounce. Not futures contracts, not paper derivatives, actual metal changing hands for immediate delivery. This represents a $15 premium over New York futures. In commodity markets, such divergences typically last hours, maybe days, before arbitrage forces convergence. This gap has persisted for weeks and continues widening. This discussion is for educational and analytical purposes only and does not constitute financial advice. The conventional explanation points to temporary supply disruptions or seasonal demand patterns. Industry publications describe it as a regional pricing anomaly that will normalize once shipping routes reopen or inventory levels rebalance. But the conventional explanation misses the deeper structural reality emerging across global supply chains. What we are witnessing represents more than a pricing disconnect. We have crossed a threshold where physical materials markets are beginning to decouple from financial markets. The era of paper contracts determining real-world prices for critical materials appears to be entering its final phase. The Shanghai Premium tells a story that transcends normal market mechanics. It reveals an industrial system under stress, where factories and refineries compete for immediate access to materials that can no longer be sourced through traditional channels. When physical availability becomes constrained, the distinction between paper promises and tangible assets becomes brutally clear. This shift did not happen overnight. For months, inventory levels at major Chinese exchanges have been declining while industrial demand has accelerated. Solar panel manufacturers, electronics producers, and battery facilities have been drawing down stockpiles faster than replacement supplies arrive. The premium represents the price industrial users will pay to secure material they need to keep production lines running. The divergence extends beyond simple supply and demand imbalances. It signals a fundamental change in how critical materials flow through the global economy. For decades, pricing mechanisms developed in financial centers have determined the cost of physical commodities worldwide. This system functioned when transportation was reliable, storage was abundant, and industrial users could source materials with reasonable lead times. Those conditions no longer apply to silver. The metal has become too critical for too many industries experiencing simultaneous growth. The convergence of renewable energy expansion, electronics miniaturization, and electrification has created demand patterns that existing supply chains cannot accommodate through normal market mechanisms. The technology driving this transformation involves more than simple industrial growth. A specific breakthrough in energy storage has fundamentally altered how silver functions in advanced manufacturing processes. This breakthrough has moved silver from being an industrial input to being an essential component in next-generation energy systems. Solid-state battery technology represents the most significant advancement in energy storage since the development of lithium-ion cells 3 decades ago. Unlike conventional batteries that use liquid electrolytes, solid-state systems eliminate the fire risk and charging limitations that have constrained electric vehicle adoption. The technology promises 9-minute charging times and 900-mile driving ranges. The critical innovation lies in the anode design. Traditional batteries suffer from dendrite formation, microscopic crystal structures that grow during charging cycles and eventually cause short circuits. Solid-state systems prevent dendrite formation through a silver-carbon composite layer that regulates lithium-ion movement. The silver component dissolves lithium evenly across the anode surface, preventing the spike formations that lead to thermal runaway. This application differs fundamentally from silver's traditional industrial uses. Instead of requiring microscopic amounts for electrical contacts or circuit boards, solid-state batteries incorporate grams of silver as an active material in the electrochemical process. The silver becomes embedded in the battery's core functionality rather than serving as a secondary component. Samsung, Toyota, and other major manufacturers have confirmed plans to begin mass production of solid-state batteries by 2027. The timeline has accelerated as automotive companies face regulatory mandates to eliminate internal combustion engines. European and American jurisdictions have established firm deadlines for electric vehicle transitions, creating inflexible demand for advanced battery technologies. The chemistry cannot be altered to reduce silver content without compromising safety and performance. Alternative materials have been tested extensively, but none provide the stability and conductivity required for commercial applications. The silver-carbon composite represents the only known solution to the dendrite problem that allows solid-state batteries to function reliably under real-world conditions. The demand implications become clear when examined through production mathematics. Current electric vehicles use approximately 30 to 50 grams of silver in control systems and wiring. Solid-state batteries require an additional 50 to 200 grams per vehicle, depending on battery pack size and performance specifications. This represents a 4 to 8-fold increase in silver consumption per vehicle. Global automotive production exceeds 90 million units annually. Electric vehicle market share is projected to reach 50% by 2030, representing 45 million units. If 20% of these vehicles use solid-state technology with conservative silver loading of 100 grams per vehicle, the automotive sector alone would consume approximately 290 million ounces of silver annually. This single application would absorb 35% of current global mine production. The calculation assumes conservative adoption rates and modest silver content per battery. Aggressive scenarios involving larger battery packs and faster adoption rates suggest automotive demand could approach 400 million ounces annually by 2032. Current global silver production totals approximately 830 million ounces per year. Industrial applications already consume 600 million ounces annually, primarily for solar panels, electronics, and traditional automotive components. The addition of solid-state battery demand would push industrial consumption above mine supply, creating a structural deficit that cannot be resolved through increased production. Silver mining faces constraints that prevent rapid supply expansion. 72% of silver production comes as a byproduct of copper, lead, and zinc mining. Silver prices alone cannot incentivize increased production when the primary metals determine mining economics. New dedicated silver mines require 5 to 8 years from discovery to production, far too slow to address near-term demand increases. Geological constraints compound the timing problem. Silver ore grades have declined consistently over the past 2 decades as easily accessible deposits have been exhausted. Modern mines process 4 times more rock to extract the same amount of silver compared to operations from 20 years ago. This requires proportionally more energy, water, and labor, increasing production costs even when silver prices rise. Political factors add additional complexity to supply expansion. Mexico and Peru produce 45% of global silver supply. Both countries have implemented restrictions on new mining permits due to environmental concerns and social opposition. Existing operations face increasing taxation and regulatory requirements that reduce profitability and discourage expansion investments. Recycling cannot bridge the supply gap during the critical transition period. Silver recycling rates remain below 20% globally due to the metal's dispersed applications. Electronic devices contain microscopic amounts of silver that cost more to extract than the recovered metal is worth. Solar panels have 25-year operational lives, meaning silver installed today will not return to the market until 2050. The recycling that does occur primarily comes from jewelry and silverware, applications that represent declining market shares as industrial uses expand. Automotive applications compound the recycling challenge because battery silver will be locked away for 15 to 20 years before vehicles reach end-of-life processing. These supply constraints create conditions where industrial users must compete for limited available material. The Shanghai premium reflects this competition in its most direct form. Chinese manufacturers, facing immediate production requirements, bid above international prices to secure silver supplies that may not be available through normal distribution channels. The divergence between physical and paper markets historically emerges during commodity transitions where new demand patterns overwhelm existing supply chains. Rhodium experienced similar dynamics in 2020 when automotive demand exceeded available supply. The price increased 14-fold as manufacturers competed for material needed to maintain production schedules. Silver's situation differs from previous commodity squeezes because multiple industries are simultaneously increasing consumption. Solar panel production continues expanding as renewable energy deployment accelerates. Electronics manufacturing grows with artificial intelligence and data center construction. Electric vehicle production scales according to regulatory mandates rather than market preferences. This convergence of demand sources creates competition between sectors that traditionally operated independently. Solar manufacturers compete with battery producers for the same material. Electronics companies compete with automotive suppliers. Each sector faces production requirements that cannot be delayed without significant financial and strategic consequences. The paper derivatives markets that have historically determined silver pricing were designed for a different industrial reality. When silver functioned primarily as a monetary metal or minor industrial input, futures contracts provided adequate price discovery for relatively stable demand patterns. The current transformation involves demand that is both massive in scale and inflexible in timing. Financial markets respond slowly to physical reality when the changes involve industrial processes rather than financial flows. Traders and analysts focus on economic indicators and monetary policy, while missing shifts in manufacturing technology that alter fundamental supply-demand relationships. The delay between physical reality and price recognition creates opportunities for divergence like the Shanghai premium. Market makers and bullion banks have structured their operations around predictable demand patterns and elastic supply responses. The solid-state battery transition introduces demand that cannot be reduced through higher prices because the material is essential for technologies mandated by government policy. This inelastic demand breaks traditional price discovery mechanisms. The psychological dimension of the transition involves recognizing that familiar market patterns may no longer apply. For 40 years, paper markets effectively controlled precious metals, pricing through derivatives trading that dwarfed physical volumes. This system functioned when physical demand remained relatively stable and predictable. Industrial users now represent the marginal buyers who determine pricing at physical delivery points. These buyers evaluate silver not as a financial asset but as a production input required to meet contractual obligations and regulatory requirements. Their willingness to pay reflects the cost of production disruption rather than investment return calculations. Skeptics point to historical examples where commodity shortages proved temporary as supply adjusted to higher prices. The silver situation differs because supply expansion is constrained by geological and political factors beyond the influence of price signals. Additionally, the demand growth is driven by technological requirements and regulatory mandates, rather than economic preferences that might change with price increases. Others suggest that technological alternatives will emerge to reduce silver consumption in critical applications. Historical analysis indicates that material substitution in advanced technologies typically requires years of research and testing before commercial viability. The solid-state battery breakthrough represents decades of development work, and viable alternatives would require similar timeframes to develop and scale. The Shanghai premium indicates that physical silver markets are already responding to these structural changes, even as financial markets continue operating under assumptions that may no longer reflect industrial reality. The divergence suggests that pricing mechanisms are beginning to shift from financial centers to physical delivery points where actual supply and demand intersect. This transition appears irreversible once industrial requirements exceed available supply through normal distribution channels. The physical constraints that create shortages cannot be resolved through financial engineering or policy adjustments. Material science and mining geology impose limits that financial markets must eventually acknowledge. The structural changes driving the Shanghai premium are already influencing real-world production decisions and supply chain strategies across multiple industries, establishing new baseline conditions that will shape commodity markets for years to come. The manufacturing facilities that produce the batteries powering tomorrow's transportation grid have begun stockpiling raw materials at prices that defy conventional market logic. These procurement decisions, made behind closed boardroom doors in Detroit and Stuttgart, reflect calculations that have nothing to do with quarterly earnings reports or analyst consensus. They reflect recognition that the materials required for the next phase of industrial development may not be available through traditional supply channels at any price. The disconnect between these private procurement strategies and public market pricing suggests that fundamental assumptions about resource availability are being quietly revised by the institutions that will determine how the global economy functions over the next decade. While financial markets continue pricing silver as if industrial demand follows predictable patterns established over previous decades, the largest manufacturers in the world are behaving as if those patterns no longer apply. This behavioral divergence between market pricing and corporate procurement indicates that the transition from internal combustion engines to electric vehicles has crossed a threshold where material constraints impose limits on industrial planning. The companies responsible for producing millions of vehicles annually can no longer rely on just-in-time inventory management for critical materials. They must secure supplies years in advance or risk production shutdowns that would cascade through the global economy. The technology driving this procurement behavior involves more than incremental improvements to existing battery systems. The breakthrough that has redirected corporate supply chain strategies represents a fundamental advancement in energy storage that eliminates the safety limitations that have constrained electric vehicle adoption. But this advancement comes with material requirements that cannot be satisfied through existing supply chains operating under traditional procurement models. The chemical innovation that enables this advancement centers on preventing dendrite formation in battery anodes. Dendrites represent the fundamental barrier that has limited charging speeds and operational safety in lithium-ion systems for 3 decades. These microscopic crystal structures grow during charging cycles and eventually pierce the separator between anode and cathode, causing thermal runaway and fires. Solid-state battery technology eliminates dendrite formation through a silver-carbon composite layer that regulates lithium-ion movement across the anode surface. The silver component functions as a host material that dissolves lithium ions evenly, preventing the concentrated deposition that creates dangerous crystal spikes. This allows batteries to charge in minutes rather than hours, while eliminating fire risk entirely. The role of silver in this system differs fundamentally from its traditional industrial applications. Instead of functioning as a conductive coating or electrical contact, silver becomes integrated into the electrochemical storage process itself. The metal is consumed as an active material that cannot be substituted without compromising the technology's core functionality. This integration means that solid-state batteries require grams of silver per cell rather than the microscopic amounts used in conventional electronics. A full-size electric vehicle battery pack could incorporate 50 to 200 grams of silver, depending on capacity and performance specifications. This represents a 4 to 8-fold increase in silver consumption per vehicle compared to current electric models. The demand implications emerge clearly when scaled across projected vehicle production. Global automotive manufacturing exceeds 90 million units annually, with electric vehicle market share approaching 50% by 2030, according to regulatory mandates in major markets. If 20% of electric vehicles use solid-state technology, which represents conservative adoption based on manufacturer announcements, automotive silver consumption would reach approximately 290 million ounces annually. This single application would absorb 35% of current global mine production. The calculation assumes modest silver content per battery and gradual adoption rates. More aggressive scenarios involving larger battery packs and faster technology deployment suggest automotive demand could approach 400 million ounces annually within a decade. Current global silver production totals approximately 830 million ounces per year, with industrial applications already consuming 600 million ounces annually. The addition of solid-state battery demand would push industrial consumption above mine supply, creating a structural deficit that cannot be resolved through increased production within relevant timeframes. Silver mining operates under constraints that prevent rapid supply expansion. 72% of silver production comes as a byproduct of copper, lead, and zinc mining operations. Silver prices alone cannot incentivize increased production when the economics are determined by primary metals markets. Dedicated silver mines require 5 to 8 years from discovery to production, far exceeding the timeframes over which automotive companies must secure battery material supplies. Geological realities compound the supply timing problem. Silver ore grades have declined consistently over 2 decades as accessible deposits have been exhausted. Modern mining operations process 4 times more rock to extract equivalent amounts of silver compared to operations from 20 years ago. This requires proportionally more energy, water, and labor, increasing production costs even when silver prices rise significantly. Political factors add complexity to supply expansion scenarios. Mexico and Peru produce 45% of global silver supply. Both countries have implemented restrictions on new mining permits due to environmental concerns and social opposition. Existing operations face increasing taxation and regulatory requirements that reduce profitability and discourage expansion investments. Recycling cannot bridge the supply gap during the critical transition period when solid-state battery production scales. Silver recycling rates remain below 20% globally due to the metal's dispersed applications in electronics. Devices contain microscopic amounts of silver that cost more to extract than the recovered metal is worth at current prices. The recycling that does occur primarily comes from jewelry and silverware, applications that represent declining market shares as industrial uses expand. Automotive applications compound the recycling challenge because battery silver will be sequestered for 15 to 20 years before vehicles reach end-of-life processing. The silver consumed in solid-state batteries installed today will not return to the market until the 2040s. These supply constraints create conditions where industrial users must compete for limited available material through mechanisms that traditional market pricing does not capture. The physical delivery markets where actual metal changes hands reflect this competition more directly than derivatives markets where contracts trade without metal movement. Historical commodity markets have experienced similar dynamics when technological transitions created demand patterns that overwhelmed existing supply chains. Rhodium markets in 2020 provide a relevant parallel. Automotive catalyst demand exceeded available supply as emissions regulations tightened globally. The price increased 14-fold as manufacturers competed for material needed to maintain production schedules. The Shanghai premium persists because physical reality has already moved beyond the assumptions that govern financial market pricing. The manufacturers who will determine global transportation infrastructure over the next decade have quietly acknowledged that material availability represents a constraint that transcends market mechanisms. Their procurement decisions, supply chain modifications, and production planning timelines reflect recognition that the transition from conventional to advanced battery technology has crossed a threshold where material science imposes limits on industrial policy. The structural changes that created the $86 physical price in Shanghai are already reshaping corporate strategy, regulatory planning, and international trade relationships in ways that suggest the divergence between financial markets and physical availability will continue expanding. When the companies responsible for producing millions of vehicles annually begin operating under assumptions that traditional supply chains cannot support their material requirements, the pricing mechanisms developed for previous industrial eras become increasingly disconnected from the reality of resource allocation in advanced manufacturing.